Ladies and gentlemen, welcome to the SoFi Weekly. I never really got to hear your opinions of the Fireside chat. We listened to them together, but then once it ended, we just kind of left.
It reinforced a lot of what they're saying. And the more that they say the same things, the more that they're going to highlight the gap between how ridiculous the low analyst expectations are relative to what the company is expecting for 2026. That's what we want. As a long-term SoFi shareholder base, we want them to keep reiterating the same promises, especially as more time passes and as we get closer to the date. It's good to see that they're still on track for that, especially because it doesn't account for any of the new product lines, anything that doesn't exist today. And we know that they're going to be introducing stuff till 2026.
They have a cross sell of 30% of users get a second product in the first 30 days. So now you're getting in these members, if they're SoFi Money users, 50% of them are going SoFi Plus, and then potentially 30% of them. I bet you the SoFi Plus cross sell numbers are actually much higher than the non users, but still. Another one, they really tried to highlight that the gap EPS of 55 cents to 80 cents was going to be achieved regardless of any new services, products, new acquisitions, or anything.
Their range for 55 to 80 cents in 2026 is already above the analyst expectations for 2026. And we know, like, it's almost a guarantee that in the next 2 years, they're not just going to do nothing. They're going to introduce new product lines. If you just look at the company's trajectory over the past several years, they've been introducing new product lines like pretty much every year. And so you just extrapolate that trend linearly, and you're like, okay, well, even if they don't do anything, they're still above analyst expectations, and we know they're going to do something new. So, I mean, yeah, they could definitely come in, at the top end of the range, even higher than that. Like, but I don't think it's crazy to see like close to $1 EPS by the end of 2026 if they can execute effectively. 2027, yeah, for sure, absolutely. And it's just nowhere on the radar for these analysts.
The thing is that we know that there's products coming that are not guided for. Like they said, without expanding any credit card offerings. And I think all of us are like 99.9% sure they're going to be doing that in the next 6 months, right? Like this year. I think they'll start at least getting into SMB checking and savings and lending as well. And it does take them about 18 months to really ramp a new product, right? Because they take it slow at first, make sure they've got all the fraud and everything taken care of, make sure their underwriting's right if they're doing SMB lending. But at the same time, like no new business lines, no new cards, no new anything. And that's what the guidance is for. It seems like there's a lot of room for upside there.
What else was there in the call that you guys really liked?
The tech platform stuff was really interesting, but I think it really sets the expectations for what people should be looking at. It takes about 2 years for them to go from the initial conversation all the way down to they're actually making money from these partnerships. Extrapolate that out, money that they're making today or the new members that they're onboarding or whatnot, those are really deals that they've started back in 2022. They're 2 years behind essentially. So the deals that they're starting today, we can expect them to conclude in 2025, 2026, because he said many of the top US banks and the conversations are going extremely well. The reality might be that they've had some conversations, but they're nowhere close to closing that deal or us seeing those numbers because that RFP process, especially after they went after more legacy, larger deal sizes. He said it can take 1 to 3 quarters just to sign up a client, and then they're going to integrate. You can assume a POC, which is going to take like a year and a half. We won't hear about the deals that they're talking about until a couple years from now. What we saw with regards to the Citibank stuff, the Reddit community, Bender9000 pulled this. The mentions of Citibank in the code base for SoFi was the earliest mention was in 2022. These have been partnerships years in the making.
It's really important, at least for me, that they do have such good vision into the future. They should have a lot of insight into what the future revenues look like. Obviously, there's the other part, how many people Chime and Dave and everybody else signs up and how many cards they issue and how many transactions are processed there. Like, a lot of people are doubting kind of their 25% CAGR for the next 3 years. I think they have pretty good line of sight on that personally, just based on what Tevis was saying.
The 85-cent prediction that you have for EPS, that's very bullish for me. I just can't imagine the actual earnings accelerating so much and then continuously holding it up. I have like right in their midpoint of their guidance, like 68 cents for the year. There might be some other players that don't see it that way. I think everyone's sort of questioning question on their minds is, why did Qatar Investment Authority end up selling nearly 20 million shares?
These guys were pre-IPO investors. I think they had a 500 million initial investment back in 2019. They had a board seat. They had all of these shares. And to me, it really was a matter of the warrants situation. If you remember, there were, I think, 11.2 million warrants that converted 1-to-1. I think the stock price was supposed to hit like $8.86. But since SoFi didn't close at that level, it closed like mid sevens on May 19th. These warrants expired and they weren't converted. And that's good because SoFi avoided some dilution. But I believe as a result of that, it seemed as though they were really riding these warrants. And then when that didn't pan out, they just sold out of their position altogether.
They invested originally, I think it was 2018, it might have been 2019. I know it was pre-IPO, and it was a $500 million funding round. And the majority of that was preferred shares. So like 312 million of it were the preferred shares that are getting the 12% dividend over the last 5 years. They've been getting a large dividend. We're talking like $40 million ish every single year for the past 5 years, right? They definitely are in the green on this, but those preferred shares were also just redeemed. So they just paid them, $312 million or whatever it was, in order to redeem those preferred shares. And that was actually the majority of their investment. So the warrants and then the 20 million shares that they just sold out of yesterday were also part of that, but it was less than 50% of their initial investment. More than 50% of their initial investment, like 60% of their initial investment plus, was already gone, if that makes sense. So that provides a little bit of context. I mean, it's never a good thing for a large institution to sell out of a stock, right? Like, that's never a positive thing. But the fact that they already were kind of liquidated on over 50% of their holdings does add a little bit of context to why it's possible that they might just want to move the whole thing into a new investment rather than keep this common stock that represents kind of a small portion of their original investment.
They may not want to wait longer for this investment to turn around. I mean, the preferred shares were paying such great dividends. I guess that closed out now, so they're moving on. They've been around for an extremely long time, and then once the preferred shares closed, they left. That's probably what it's tied to.
So
It's a dead stock. Yeah, I mean, for now, I think the idea is trying to find stocks that are undervalued and could potentially turn around. Rates are a massive part of the stock market, let alone financial lending companies. Will that always be the case? And will you have another opportunity to buy at depressed prices? I can't guarantee. So, in fact, B-Dubs thinks today is not going to be the bottom for this stock price. What do you guys think? Do you have any opinions of short-term price action here?
I can totally understand how the sentiment is at lows right now because it seems as though those big catalysts for the business just keep getting pushed back more and more. And I think a large part of this has to do with rates because back in December, January, we're thinking that we're going to have way more rate cuts than we actually are expecting now. And now we can say, okay, well, we have one rate cut towards the end of the year because don't forget, Wednesday, we also had the CPI numbers. We had the Fed decision to keep rates steady. And so it seems as though, even with the comments that they're reinforcing now on 2026 numbers, that we're moving that yardstick further down. We have catalysts, but they're not in the next immediate couple of months or even immediate couple of quarters. 2025 can be a really fantastic year. 2026 even more so. But I think a lot of investors were thinking that 2024 was going to be that year as a result of having more rate cuts than we actually ended up having.
But I do think it's interesting that everybody's talking about how markets are at all-time highs. And the truth is that the S&P 10 is at all-time highs and everything else is kind of just meh. And then small caps and mid caps are actually below where they were for in terms of valuation, like a PE for the entire index. They're below where they were from 2013 through 2019. It is true that the S&P 500 is at all-time highs. The NASDAQ 100 is at all-time highs, but it's really just down to the Mag 7. They are carrying the entire weight of the entire index. And when you look at the S&P 10 over the S&P 500, the relative valuations between the two, it is the same as it was at the peak of the bubble in 2001. There's some really weird stuff going on with this macro. And the fact that those big stocks are at all-time highs is really kind of masking what's going on underneath. Most mid and small cap are at really, really good valuations historically, even though the S&P 500 is at all-time highs. And SoFi is going to trade with the Russell, and SoFi is going to trade with those mid-cap stocks because that's the size that it is, right? It's not going to be in the S&P 500 for at least a few years. And so it's not going to be considered a large cap until it gets up in those ranges. People are saying SoFi is a dead stock. It has been, right? Like it hasn't gone anywhere for 2 years and it's frustrating. And I agree that that's really frustrating. But at the same time, if you look at kind of those small and mid cap stocks, it's actually trading about the same, despite the fact that fundamentally it's doing way better than all of its competition.
I think that some of the longer term shareholders will look at the company fundamentally and say, hey, what has improved during this time? If I was buying the stock 2 years ago, roughly around the same price, back whenever it had less than 4 million members, am I still willing to buy this company at 8 million members for the same price? And I think that that's sort of the thing that keeps bulls continuously coming back and saying, hey, this is a very interesting play, because fundamentally things have stayed not even the same, actually improving. And so it's hard to say that this is a dead stock, because that doesn't necessarily mean that that'll be the case forever. And I always bring back to that Peter Lynch quote, but things can get disconnected for an extremely long period of time, sometimes multiple years. But in the long run, there's 100% correlation between the fundamentals of a stock and the actual success of its share price. So really, we should be addressing this company every quarter or every time that they have some new type of product or something like this to come out and say. But if it's taking away from your sleep, if your time horizon is shorter, then this is not the stock for you.
For me, at least, I feel like it's easier to hold SoFi now than it ever has been personally. A lot of it's been de-risked. I guess there's a chance that if we hit a really hard landing, we're talking about like a really deep recession, it's going to suck. But it's also going to suck for every single stock on the market at that point. Unless that happens, even in the soft landing, and especially if there's no landing, right? It's now got profitable. It's grown for years and years and years. I trust the management and I trust everything that they say, because every single time they've made a quantitative promise, they've delivered on it. At least personally, my conviction is higher than it's ever been, only because I feel like it's a better risk reward than it's ever been. A lot of the things that could have been bear cases and could have possibly derailed the stock, SoFi is either guided for something that said, hey, we're going to take care of this, and then they beat that guidance, or they've had something come up that was out of their control, and then they pivoted and were super agile and found a way around it to where the bear case just disappeared over time with execution. It might go sideways for the next 2 years. It's possible that somehow the narrative that it should be priced as a bank and have single-digit PE ratios might hold true, right? I don't subscribe to that theory. I think that that's ridiculous, but maybe the market disagrees with me, and maybe that's what's going to happen. But at the rate they're going, and with the guidance they've given, we're 2 years away from them being at a price to earnings of 10. And at that point, if they continue to grow it at 25% a year, then the stock will grow at 25% a year. I feel really comfortable and confident holding. It's not an issue for me personally.
This isn't an undervalued stock. In fact, the book value is almost 6. One, what book value are you remotely thinking about? Price to book's about 1.5 times. Price to tangible book value is probably around a little less than 2 times.
Fundamentally, the only reason any stock should be trading on a price to book or price to tangible book value is if you believe its future earnings is limited by its book value or tangible book value, because they can make money based on the amount of assets that they have. And so the amount of assets and the capital that you have is the limiting factor for your growth moving forward. So if you can only return 10% on your assets, then that means that you should trade at whatever book value is equal to the earnings that are 10% of your assets compounded. My personal feeling is that SoFi is not limited by their book value in terms of their growth rate. If you look at their growth rate for the past 5 years, it's over 50%. Now, they were only a bank since 2022. So how in the world can a company who can grow their revenues by 50% be limited by their book value? They've got a lot of ways to generate capital light earnings and revenue. So there's the entire tech platform, which gets basically ignored if you just price it on tangible book value, which is it's a software service, and those typically come with higher valuations. And then not only that, but I think that they're able to grow in capital light ways that other banks typically can't. And one of the reasons is because they're such a small bank. So if you're a behemoth like JP Morgan and you initiate a ton of loans, there's nobody who's going to buy those loans off of you. You have to hold them because you can't just sell trillions of loans. But I mean, SoFi's entire book is $20 billion, right? Like all their personal loans and all their student loans. Like that's a drop in the asset ocean of banks. If they're able to originate and sell, that's capital light revenue. For example, all of their mortgages, they don't keep a single mortgage basically longer than 3 months. They cycle their entire mortgage book every single 3 months. So that's all capital light revenue that's coming in from the mortgage business. Prior to 2022, that's how they ran their entire business with student loans and personal loans as well. They would be cycling their book, meaning that they're selling all of the loans that they originate every 3 or 4 months. And they're a bank now, and they're able to then get lower cost of capital, and they're able to originate more and hold more, and holding them has a higher return on investment than selling them. But if we get into an environment where rates are coming down, where liquidity returns to capital markets, and we're already starting to get there. So there's a lot more liquidity in capital markets this year than there was last year already. Maybe at that point they start to flood the market with too much paper, and they're not able to do that anymore, right? And then there's other things that they can do also. So like all the interchange revenue, the fact that they're building this lending as a service, SoFi Lantern, that's all capital light revenue. There's a lot of other things and other levers that they can pull that they're flexible enough and agile enough to take advantage of that just isn't encompassed in the book value. And then the second reason that I think that it's ridiculous that now that they're a bank holding company, so now that they have a banking license, they should be valued as a bank, is because just fundamentally, like if you think about SoFi with a banking license and SoFi without a banking license, which is the better fundamental company? The answer is absolutely with a banking license, because it gives them more flexibility, it gives them lower cost of capital. So how in the world can you legitimately argue that getting a basic banking license means that it should be valued lower if it's fundamentally a positive thing for the company? It's just mental gymnastics that I just cannot get my head around, where you say something good for the underlying company and that makes it a better company and a more robust company and a more flexible company and one with lower costs makes it valued less. Like that makes no bloody sense.
I also just want to show a chart of SoFi's tangible book value, just in case you are that investor that is worried about SoFi being priced based on book value, is that this is also a point in which they want to grow as well. So I want to do a little fun question for you guys. There's 3 segments of SoFi. Their current expectations is that lending is going to bring in 92 to 95% of revenue of last year's revenue, so a slight decline. Financial services is expected to grow by 75%, and the technology platform, I think, is at 20%. If you could pick a segment that is going to outperform this year of their expectations, so they're already graded based on how well they think they're going to do, but which one do you guys think has the highest likelihood of outperforming this year?
I feel like financial services is probably the obvious answer there. I want to say lending really badly, but if we don't do anything from a rates perspective, and that might be tough. I feel like financial services personally.
Wasn't part of their guidance for lending that they are assuming, is it no rate cuts? Or is it still 4 rate cuts?
It is 4 rate cuts, but it's unemployment above 5% by the end of 2024 and GDP contraction, so negative GDP growth by the end of Q4. If you go back and read the transcript, that's the reason they said that there would be 4 rate cuts, is because they believe that basically the macro is going to be breaking down and we're going to be in a recession. I think Tevis is right, and I probably agree with him that the easy one to pick is probably financial services, because we're pretty confident that they're going to be rolling out credit cards there, and because they're already ahead of schedule. And so I think that's probably the one that is the easiest choice. I actually think that there is upside in lending relative to guidance, only because the macro has held up. If the macro holds up and we have positive GDP and only, call it low 4s unemployment by the end of this year, that's better for SoFi than if you have really high unemployment, deteriorating GDP, and 4 rate cuts, right? Like if you look at the guidance as a whole, that's a more negative thing for SoFi's lending than having what we're currently at continue through the rest of the year. So I do think there's some upside there. I guess the one caveat to that is that lending right now is totally up to what management wants to do. So the interesting thing is they could be growing their lending segment by 20% this year if they chose to, especially with the convertible note deal, right?
Yeah.
They have the capacity to do it. So it's interesting to say lending has upside available, but all of that upside is completely up to management. And if they want to scale back and really make sure that they have that future capacity later on, they might purposely go to 95%, even though they easily could be at 100%.
I think the sleeper pick is lending. If they want to turn it on, it can come on. I don't think that if they want to turn on financial services, that means that they do better than 75%.
Financial services is like the only one that they left uncapped. They were like 75 plus. And I think it was like at 86, like the year over year last quarter, something like that.
Yeah, but they're kind of doing that with lending too, right? Like they're saying, hey,
No, they're saying 92 to 95 for lending.
That's if they feel that the macro, or that they think that things are going to be so pessimistic, that if there's any feeling of change, like Chris said, it's just going to ramp up the amount of applications that we accept. They're literally all there. It's like they're waiting in line for SoFi to just go, okay, approved. And then we have an additional $1 billion of originations. There's easier ways for them to ramp that. I think the tech platform is the one that actually has the least likelihood of outperforming, just because they probably know the size of the companies that are already coming on, and they're not going to see any surprises because the deal lengths are probably longer than 12 months. That is probably going to come in right around their guidance, if I was to assume.
Tech platform is also the more predictable one because it's the only B2B segment that they have. In B2B, they're generally working with, annual renewals. They're working with deal sizes that they have some expectations of close. They have a lifetime value. Whereas in the B2C segments, there's more factors that can go into that can help you underperform or outperform depending on what the macro is. Whereas for B2B, like the deal time and pipeline for a deal is so long that it's more predictable revenue.
How do you feel about SoFi right now? What do you think about Qatar Investment Authority selling SoFi shares? What did you think? Did you get to see the SoFi Fireside chat? Did you?
I could care less about them selling. What do I care? Well, Point came out and once again reiterated earnings. Management has never given me a reason to doubt them. Until they give me a reason to doubt them, I don't care. It's a lower price right now. I'm not selling tomorrow. I'm not selling next month. I'm not selling in a year from now. So it doesn't matter. Day-to-day price fluctuation is just that, day-to-day price fluctuation. If you want dollar cost average, great. I will probably be dollar cost averaging at something.
Have you bought in under the $7 ranges lately?
Lately, no. This year, yes. Somebody said something on Twitter, and I didn't post anything, but I did look. I think I've added 12% to my position in 2024.
He's not going all in. He needs room for Pokemon cards and such, but
no, I just finished my Tesla position today. So
nice.
Ooh, he's bullish on.
I'm all in on Tesla.
$600 billion of
Tesla's got more potential than Nvidia at this point.
All right, ladies and gentlemen, if you want to join, hit down below, members only chat. It's both available on my channel and Tevis's. But until next time, thank you so much for watching. Bye for now.